Hello there, everybody. How's everybody doing today? It's already hump day. Wow, shortened week. It's already Wednesday. Um, Market a little bit calmer today. Google big mover, Apple big mover. Other than that, pretty calm overall. I think everyone's kind of gearing up now for the jobs report on Friday morning. I hope many of you were able to join me just over the last half hour, 45 minutes or so. I was interviewed on a T3 kind of market minds like show. It was a great discussion across the board. I will let everybody know the next time I am going to be on there. All right. I think that catches us up for where we are in the market right now. Let me see. We'll start off. S&Ps are up 16 points. NASDAQ's up about 200 points. The Dow is down a couple hundred points. So fairly large discrepancy there. Thank you, Thomas. I appreciate that. Now, we are going to get to the bond market and what is going on. But before we do that, everybody, please subscribe, smash the like, all that good stuff, please. I would appreciate that. All right. And today it is all about what is going on in the bond market. And I'm hoping that the dogs aren't going to start barking back here soon because they just, I think, sensed something out there right now. But if you haven't noticed, okay, bond yields have been soaring recently, which means bond prices are going down. Now, something out of whack there because if the Fed is expected to cut rates in the next couple weeks, and their benchmark interest rate is going down, why do we see, especially on what's called the long end, why are those rates really going higher? And who knows what the long end of the bond yield curve means? The short end, there's the long end, and it doesn't have anything to do with a short or a long position. And I'm hoping everybody can. There we go. Thomas, thank you. You don't know. That is a great answer, honestly. Dave, okay. The long end of the curve means the further you go out in time. So if you hear reference on TV or an article or something about the long end, typically that's referring to either the 20 or the 30-year bonds. Short end of the curve would be really up to like 2 years. Exactly, Scott, 20 and 30 year. So while we're seeing short-term rates potentially come down, especially if the Fed does cut rates, that longer end of the curve, those rates are going higher. And typically over time, there's that discrepancy is not a great thing. So what is going on? And it's not just here with US bonds. Okay. Yesterday, this is not just US corporate bonds, but this is also investment grade issuers. What does that mean? That means it could be local municipalities. Investment grade means that they're very high quality bonds. Yesterday, auctions 58 different bonds of over $40 billion. Okay. Now, what does that mean? That means whether it's the US government, whether it's corporate entities, whomever it might be, municipalities, if there are more and more and more bonds for sale, okay, what do you think that means in terms of bond prices and bond yields? Anybody? Simple supply and demand, everyone. Which one is lower, Guillermo? The yields or the prices? Dave, same thing. Which is lower? What's down? Yields or prices? Remember, the bond market can be a little confusing. How about anybody besides Guillermo and Dave? Okay. Excellent. Excellent. If prices are falling because there's a lot for sale, okay, so people are not willing to buy at the price up here when they know there's more for sale, so that price keeps moving down. Well, if the price is moving down, what does that do to yields? Yields move up. So Aladdin, it's the exact opposite of that. Prices go down, yields go up. Remember, in the bond market, price and yields, or the interest rate, they're inverted, or they're inversely correlated to one another. When bond prices go down, yields are going up. So think of it this way. If there's a lot of bonds for sale, again, doesn't matter, US government, municipal, corporate, if there's a lot of bonds for sale, okay, well, you're not going to keep buying them at the same price, just like with an option, right? If all of a sudden there's a ton of one particular option, whatever it is for sale, that price is going to become lower and lower and lower. As the price becomes lower, those corporations or the US government, whomever it is, in order to sell those bonds, they have to make it more attractive. How do they make it more attractive? They raise the rates, okay, on your investment. But it is not just here in the US. It is a global, I'm not going to say crisis right now, but it is a global situation where we are seeing yields moving higher globally. Okay, Australia, Japan, the UK, France, everywhere you can think of. Okay, so why is this happening? Why is this happening? Well, a couple reasons. There's really heavy concern about government spending. Okay, and inflation. The concern about inflation. So, what is the potential problem here? Okay, what caused this since last week? And I'm looking at this. Okay, so of course, we're talking about this, and the 5-year yield just fell today. The 2-year, I'm looking at this right here, a headline here. The 2-year is coming down, and we'll look at some live markets here. But that long end of the curve also is rising. Okay, so what happened? Well, last Friday, after the close of the market, I don't think there was any coincidence there. Okay, I think that it was planned that this announcement came out after the market closed. But if these tariffs are deemed illegal, it's a big if, okay? And we are forced to return all of the tariff money. What does that mean? Well, it means the Treasury is going to have to issue a lot more debt. Okay? The money that they're going to need to raise is going to come from bond issuance. Well, if that happens, what's going to happen? That's going to drive yields way higher. So from that news Friday till now, the market is kind of maybe getting ahead of itself, but saying, oh boy, if this is really a scenario and the government has to give back all this money and they got to get money somewhere else by selling bonds, we got to get ahead of that. Okay, and yes, the U.S. Treasuries, the least risky asset probably in the entire world. typically dubbed as risk-free, though there really truly isn't anything risk-free, but that's as close as you can get to it. However, if the government starts just massive amounts of selling of these bonds here, all of this supply, as I said here, investors are going to demand higher yields. So we see, we could see the 10-year get close to 5%, the 30-year get to 6%. If that happens, boy, the equity markets are going to take it on the chin. Now, I am not suggesting this is going to happen. I am not kind of, trying to be the little boy that cried wolf here or get anybody's, anxiety levels up. I'm just pointing out what could possibly happen here. And we're kind of in a situation here, which is like the perfect storm. Okay, and what do I mean by that? Okay, well, again, this is a headline from this morning in Market Watch. Okay, the current bond market turmoil described by Market Watch as a worldwide bond market rout reflects a confluence of economic and geopolitical pressures. Okay, so again, yields move inversely to bond prices. They rise when investors sell bonds. They want to get higher returns. So globally, as I just mentioned, we are seeing yields almost at all-time highs in some parts of the world right now, with the concern about inflation really not coming down, with the concern of government debt, not just here in the US, but around the world. We have a deadline coming up. It's going to, listen, it's going to start hitting the headlines. You're going to see it every single day, probably starting in a week or so, that the government could shut down October 1st. That would not be a good thing. Okay? But in the US here, the 30-year almost touched 5% yesterday. It's down a tick today. The German 10-year, and that is not misspelled there. It's not the 10-year bond. It's actually called the 10-year Bund. And I don't speak German, but that is what it is called. Those yields rose to just over 2.5%. Okay. But in the UK, in the Eurozone, wow. The UK, their 30-year bond is called the 30-year gilt. Highest it's been in almost 30 years, up at almost 5.7%. And again, this is the cause here. It is persistent inflation concerns. And quite frankly, here in the US, even with the Fed set to cut rates, the economic data, albeit not as robust maybe as it was just, a few months ago, it is still pretty strong. Okay, that is also one of the reasons now why this global bond market turmoil has fueled the price of gold. And typically, we don't see those working in conjunction with one another. But before we go through this, let's get to our word of the day here. Yes, I'm keeping the pups up here for a while. It is too good of a picture for now. Okay, so our word of the day, it's an easy one. It is bonds. It is not yield, it is bonds. Let's leave that up here for a minute or so. And a lot of you, may ask, while you're doing this here, how do we trade that? How do we take advantage of that? Well, certainly on the future side, you can, trading the 2-year, the 10-year, 30-year. On our side on the equity side of things, typically we would look at rates and trade TLT, which is the 20-year bond ETF. Okay, and I'll bring that chart up here in a moment. But let's go back here. Okay, so the concerns over government debt, and somebody mentioned it just a while ago, and especially if we have to issue a lot more here, but it's not just here in the US, it's globally, where global debt is unbelievably, you know, off the charts. It really is. Okay. We're seeing that being an issue. Japan, which most of you know, yes, I do, Scott Schaefer, we got it. Japan, which most of you know has been almost in a zero rate interest policy, seemingly forever. Okay, their long dated bond yields are now at record highs. Okay, and spot gold prices, they've peaked as investors are seeking that safe haven asset. That safe haven asset, if there is global turmoil on governments, it's shifting investment away from some of those bonds. Even though the returns, the yields have gotten better and better and better, maybe the quality, the safety isn't so good. That has definitely fueled a major part of this gold run. Okay, Japan's 30-year government bond yield, 3.25%. That is off the charts. Okay, in the UK, as I mentioned, their 30-year, almost 5.7%, the highest in almost 30 years. Okay, same thing. Just like us here, if any central bank, any government has to issue more bonds and they have to issue it at higher and higher and higher rates, boy, that puts a lot of pressure fiscally on a government with government debt. Okay, and again, I keep mentioning this, but this is really what is causing this, right? Persistent inflation, rising debt levels, and obviously the tariff situation. Okay, look at this. This is Japan. This is Japan. This is, unprecedented. Why do I have Japan up here? Well, Japan is so highly correlated. The yen is so highly correlated to the dollar. Okay, here is our 30-year yield just over the last 9 months. We're almost at those highs again. You can see we're really right up against some major resistance here. Major resistance. Okay, let me put this guy up here one more time, and then we're going to close out the word of the day here in just a moment. And what I want to bring up here is let's take a live look at some yields here today. And the best place that I go for that, everybody, is on this website right here, investing.com. There's certainly a lot of websites you can go to. I go to investing.com. I think it's fantastic. And, I just click on bonds right here. So you can see that our yields are actually down a little bit today. Okay. Where the 30-year yesterday almost hit 5%. We're just a tick or so below 4.9. But let me bring up a chart here like I just did in the presentation there on the 30-year. And, okay, this is just a monthly look over the last 12 years. You wonder why, people can't afford houses, mortgages. Okay, if we look at the 10-year, now the 10-year bond is the one that mortgages your loans like car loans. That's what that is really based off of, not the 30-year. Okay, if we look at the 10-year here, we're not seeing as significant of an increase in yields as that longer end, the 30-year, but still we're at some pretty critical resistance here. Okay, but then here's the real short end of the curve. This is a 90-day or 3-month. Okay, and you can see that while that longer end of the curve recently has been rising, the shorter end of the curve is coming down. That's because the Fed is expected to cut rates. Wheel is closed. Thank you. I appreciate that. So back here again to the 30-year. This is, it's becoming an issue. Now, I also think that because it's in the news and in the press 24/7 now, it kind of feeds off itself. It's one of those kind of FOMO moments. So, Troy, what's the live trading show? Troy, is this your first time signing in to Market Minds? We certainly appreciate you being here. Is this your first time signing in? Okay. And thank you so much for being here. And I hope you're going to be here every single day. Okay. But we talk about the topic that is hot in the news right now and how it can affect your portfolio, your trading every single day. So, no, this is not an economic opinion today. I don't give opinions. I present the facts and what the potential outcomes could be. And yes, this is live. Some days we'll discuss strategies. Some days we'll go through what is important in the economy, which obviously can affect the stock market. Okay. And if you have Paul, that is so awesome. Everybody know what Paul is talking about there? Paul, that's one of the best segues or comments I've seen. That is so good. Oh my God. Can we play that a little bit here? All right. Everybody can hear that? Great one, Paul. Love that. Love that. Love that. Love that. Anybody that's a Beatles fan knows exactly what Paul was talking about there. Yeah, there will be a show tonight. You bet it. Henry, at a broad glance, if the Fed is expected to cut rates historically, how does the market react? Is it already being priced in or not? Right? Personally, now I know I said I don't give opinions before. Okay. Personally, and this might be an unpopular opinion, I don't think they really need to cut rates, at least not given how strong the economy is. There's a lot of pressure to cut rates. That could change in a moment's notice. But let me ask everybody here, why, if they are going to cut rates, why are yields rising? Right? That's the question I have there. So anyway, Pete, Britt, I'm not sure, Troy, what the no was. If that was to everybody My question of does everybody know what it is? It's a Beatles song, so that's uh that's what that was there. Safe haven demand. Safe haven demand. Gold, bonds, those are typically your safe haven demands. When there's trouble brewing, when something is out there, when it's a risk off environment, meaning risk off typically means when equities are getting hammered. Where do people put their money? Out of the equity market into the bond market, into gold, into things like that. You couldn't hear the music? Oh no. Really? Hang on. Let me try this one more time. One more time. All right, guys. Well, I tried. It's obviously user error, not the user. I was playing the benefit for Mr. Kite by the Beatles. So sorry about that, everybody. That would have been nice to have on there. But you can all still hear me, right? Ooh, we got a nice full wheel today. Okay. All right. I'll figure out somehow how to bring in some music maybe tomorrow. Maybe we'll play a little Beatles for Paul there. All right, everybody. Nice filled up wheel today. Troy, I hope you're on here. If you're your first time in today, what we do every day is I put a word of the day out there. Today it was bonds. Yes, you can, Dorothy. Absolutely. Um, and then at the end of the show here, we will spin the wheel and the winner gets some swag. So here we go with today's wheel. Who are we going to have here? Karen, Kent, Mark, Nico. Who's it going to be? Mark, outgoing man. That is a new one on the wheel. Awesome. Mark, are you here? Mark, outgoing man, are you in the house? I sure hope so. You got to be in it to win it, but I hope you are here, Mark. Let us know if you are here. You got to be here to claim your prize. Come on, Mark. Oh, no. Mark. We'll give Mark another 5 seconds. Oh, he is here. Yes, we see him. Mark, way to go. Congrats. Okay, up on the screen here, I put an email address, prosperswag@prospertrading.com. Mark, shoot me an email there. Let me know your swag size and also a mailing address. All right. prosperswag@prospertrading.com. Also, as a heads, you're from Texas. All right, way to go, Mark. Don't know if you're a Cowboys fan, but isn't that the first NFL game tomorrow night? Cowboys Eagles. Could be a Texans fan too. Not sure. Just so everybody knows, okay, I did reach out to Tom Sosnoff at Tasty Trade. Okay. Tom and or Scott Sheridan. Scott Sheridan is the other co-founder of Thinkorswim Tasty Trade. One or both of them will be joining us next Monday to discuss how your orders get filled. When you send an order away, whether it's on Thinkorswim, whatever platform, Tasty, Interactive Brokers, okay, what happens to that order? How does it get into cyberspace, and how does your order get chosen to get filled? There is no better resource in the world probably than these two guys from Tasty Trade. So they will be with us on Monday. So that will be a great one. That will be a great one because I know everybody has a question, right? How come Johnny got filled and I didn't, right? So we will, David, you probably know that. That maybe will be the word of the day on Monday. Yes. All right. Everybody, have a fantastic day. We will see you all tomorrow.